Okay, students, so now we've covered all of these homework problems. Let's move on. Something important is explained right here where I've got it colored green. But the real purpose of the statement of cash flows is to explain the change in the cash balance from the beginning of the year to the end of the year. It's what they say right here. The purpose of the statement of cash flows is to explain why cash increased by $9 million. Now again, that's the reconciliation of beginning cash to ending cash. We're explaining how did we get there. So at the end, we come up with our net increase or decrease in cash flows, and that was $9 million. We add that to the beginning cash balance, and that should get us to the ending cash balance. Okay, and then we move on down here and see that the non-cash investing and financing activities, so they had one. UBC acquired $20 million in new equipment by issuing a $20 million long-term note in a single transaction. In other words, they signed a note with whomever they purchased the equipment from. Undertaking a significant investing activity and a significant financing activity as two parts of a single transaction does not diminish the value of reporting these activities. Now, in other words, we've got to show it, and here is the way you disclose it that's commonly done. So they're explaining they acquired $20 million of equipment by issuing a 12% 5-year note. Okay, and I think I've explained all of that. Here are examples of non-cash transactions that would be reported in this manner. So acquiring an asset by incurring a debt payable to the seller, acquiring use of an asset by entering into a lease agreement, again with the seller, converting debt into common stock or other equity securities. So if we have debt and we issue stock to pay it off, that's a non-cash investing or financing activity. In that case, it would be two financing activities. Exchanging non-cash assets or liabilities for other non-cash assets or liabilities. Again, no cash is involved, but it would show up as other non-cash investing and financing activities. Okay, preparation of the statement of cash flows. And I talked about this a little bit earlier. A difficulty in preparing a statement of cash flows is that typical accounting systems are not designed to produce the specific information we need for the statement. So that's why we have to start comparing the beginning and ending balance of current assets and liabilities to figure out the difference between the accrual basis revenue or expense and the amount of cash that was involved. So they explain a lot of that in here. I think I've explained it already, but be sure and read the book. They have a good explanation. And let's see, I was just trying to look at that and see if there's anything else I want to say. Right here they make the point, the ledger contains no balances for cash paid to acquire equipment or cash received from the sale of land or any other cash flow needed for the statement. As a result, it's necessary to find a way of using available information to reconstruct the various cash flows that occurred during the reporting period. And so there they kind of walk you through another example. This one involves purchasing equipment, paying some in cash, and then signing a note for the rest. So You can read that up in here, but you can tell from the journal entry what happened. So in that case, the $6 million would be under the cash flow from investing activities, and then the other $14 million would be reported as a non-cash investing and financing activity. Again, I think they're crazy for doing it that way and not just showing it as a $20 million inflow from an investing activity and $6 million outflow. I got that backwards. $20 million outflow from an investing activity, and then $14 million inflow from a financing activity. That would give you the $6 million net in cash flows. But that's not the way it's reported. Okay. Now there's comparative balance sheets, and there's a little bit of additional information, and those reconstructed journal entries that we did in the homework makes it easier to follow. And preparing statement of cash flows, direct method of reporting cash flows from operating activities using a spreadsheet. And so what you'll see here is I went through and tried to color code this for you. So it's the kind of stuff we looked at earlier. So here we have the balance sheet. We see that accounts receivable went up by $2 million. So what does that mean? This statement is in millions. So it went up by $2 million. Well, what does that mean? That means that cash received from customers was less than sales reported, because some of those reported sales haven't been collected yet. So we see it highlighted in blue here. That is a debit $2 million for accounts receivable. And then down here in blue, and you'll see this is number one. And down here, we see that they show sales revenue, and that looks like a 4, but it's actually a number 1. And $100 million in sales revenue. So how much did they collect from customers? Well, they had sales of $100 million, but $2 million of that hasn't been collected yet. It's still in accounts receivable. So the cash inflow from customers is $100 million minus $2 million, or $98 million. Now, here with orange, you see inventory decreased by $4 million. This is something we looked at earlier. Their accounts payable increased by $6 million. And then cost of goods sold were reported as $60 million. So how much cash was paid to suppliers? Well, we had $60 million in cost of goods sold, but of that cost of goods sold, $4 million came from a reduction in inventory. So as a result of that, we only had to pay for only had to purchase $56 million in goods. And then of that $56 million purchased, accounts payable went up by $6 million. So we haven't paid for $6 million of that. So what did we have? Cost of goods sold of $60 million. $4 million of that came from a reduction in inventory, and $6 million we haven't paid for. So we had cash payments for to suppliers for only $50 million. Okay, then we can go to, in yellow, we reported salaries payable had gone up by $2 million, and salary expense was $13 million. So we had $13 million in salaries expense, but $2 million of it hasn't been paid yet. So we only have a cash outflow of $11 million. And in this color, we have income tax payable went down by $2 million. So that means we paid $2 million more to the IRS than we reported as income tax expense. So that's number 10 right here. You see the other one, I think that's purple color when you look at it live. But anyway, income tax expense of $9 million, but we paid an extra $2 million to the IRS that paid down income tax payable. So we had cash outflows for tax of $11 million. Okay, so there you see how that works. They're using those summary journal entries to figure all that. You can see I wrote some of it out for you here. The item number 16, and right here, what did we have? Well, we had a debit to retained earnings. So a debit reduces retained earnings. That would indicate some sort of a dividend. We had a credit to common stock and a credit to additional paid-in capital. So that would indicate that it's a small stock dividend. So stock dividend doesn't show up at all on the statement of cash flows. And then item number 18, we see a reduction in retained earnings, and then we are not seeing any change in common stock. I was looking up here for cash, but it doesn't tie it in up there. But that's payment of a cash dividend, and so that shows that down here as a cash outflow from a financing activity. Right here, payment of the dividend, $18 million. Okay. Now, income statement accounts. I think we've talked about those enough. They walk you through all of those. Sales revenue, since accounts receivable increased during the year, some of the sales revenue recognized must not yet have been collected. We talked about that. So they walk you through them, show you what happens with each one, what accounts are involved. Again, I think I've covered that adequately. I hope you understand. Right here, using the equity method, which right now most equities are marked to market, shown at fair value, unless they are either consolidated or reported using the equity method. Excuse me, I had to pause it to sneeze. Anyway, that gets us into some situations where we have changes in values of assets without any cash flow involved. Okay. There they get into the gain on the sale of land. We've covered that. Salaries expense, depreciation. Under the direct method, it just doesn't show up on the statement of cash flows. Under the indirect method, it has to be added back to net income to get to net cash flow from investing activity, operating activities. Interest expense we've talked about. Insurance expense, same kind of thing. If prepaid insurance goes down, prepaid insurance is an asset. So if it goes down, that means expense was higher than the amount of cash paid. Loss on the sale of equipment, we've covered that. Income tax expense, and net income, we've talked about all that. So I'm going to stop there and I'll pick up there with the next video.